And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is Wednesday. It's the Hump Day edition of The Real Investment Show. That also means it's live Q&A day. So get into the chat right now and start posting your questions. Danny's already starting to write down a few of them, and we'll get into those Q&As here in just a moment. Whatever you want to talk about today, do stocks, bonds, politics, I don't care. Whatever you want to ask, we'll certainly cover it. We'll see if we can stump Danny today. So, ask a good retirement planning question, see if you can get him caught. Anyway, that's going on right now. So before we get there, though, of course, just a couple of things. On Monday, we posted a sector-by-sector analysis, and as I was going through all the sectors, I actually accidentally left out energy. So in today's daily market commentary, I did the energy analysis. So if you read the report on Monday on the sector-by-sector analysis, which had all your buys and stops and all that in it, the energy sector one is in the daily market commentary today. So that is there for you. Outside of that, we've got a few things that are going on this week, just wrapping up earnings season for the most part. Really, most of these companies have reported earnings. With Palo Alto Networks last night, their revenue outlook disappointed a bit, so that stock will be down a bit. But again, most of the big major companies have reported, except for NVIDIA, which is coming next week. So we will get the last big mega cap company next week, and then surprise, right after that, we're going to start earnings season all over again. So we'll be right back into this. But overall, earnings season's been good. Revenue growth for the S&P 500 has been the highest for quarter four, has been the highest level it's been in the last 3 years. So it's been a revenue growth has been strong. Now, the vast majority of that revenue growth is coming from technology companies, but that has been the highest level of revenue growth that we've seen. So again, it's been a good earnings season overall. Beats have been good. Earnings growth has been good. That's kind of giving some support to markets here as well. So while there's a lot of angst right now, again, there's this kind of ongoing tug of war between AI and technology and all this type of stuff with markets. Most of this has just been a big rotation. We talk about these rotations all the time. We were talking about we needed a rotation potentially back to value last September. And that's been the case. We've seen this rotation back to value. However, value now is extremely overbought. I just posted out on Twitter this morning an interesting chart. It's the forward PE ratio of staples companies. Now, why that's interesting is that every time that you see a post on valuations that say tech stocks are the most overvalued they've been since the dot-com peak, and then of course we have to have all these analogs about how valuations of technology stocks look just like they did in 1999, 2000. Oh my gosh, the world's going to blow up. Technology stocks are now staple stocks are now the most overbought since 1998 through 2000. Those valuations are at those same levels, but yet we don't see everybody running out now going, staples are as overbought as they were in the dot-com bust. They're all going to crash. We don't see those analogs, right? But this is about narratives, right? And again, this is why we talk about this is why it's important to always, kind of pay attention to the fundamentals, pay attention to these things, because we have these big moves in markets, which are fine. There's nothing wrong with it. These are those rotations. Just understand these rotations go back in the other direction as well. So, just because things are overvalued now in staple stocks doesn't mean they'll remain overvalued forever. So start looking. This is why it's important to pay attention to these rotations and then look for areas of the markets that have now gotten cheaper relative to their historical valuations. And those provides your next setup for the next rotation. And that'll occur. That's just a function of time. It could be 6 weeks, it could be 6 months, but that rotation will eventually occur. So just make sure you're maintaining kind of your analysis as you're going through. Okay, so here's what you need to know before the bell this morning so we can get into our Q&A. The market, we talked about yesterday, the market had come down and had tested the 100-day moving average. We bounced, we opened a little bit below that yesterday morning. And again, yesterday's morning kind of open was pretty weak, but immediately we saw buyers come in and again, we've talked about before, these moving averages have been really good areas of support. All these kind of algorithms and other investment programs, etc. They're all watching the kind of these key moving averages, and when we get down to those levels, we see buying activity come in, and we saw that yesterday. So again, right after the open yesterday, markets bounced right off that 100-day moving average. We closed positive yesterday. Futures are pointing up about another 40 points this morning. I'm not saying that this recent sell-off is over, but again, just kind of looking back here at previous history, we had 3 days of just some pretty heavy selling. Normally, we've had these kind of 3-day stretches before, 3-4 days, and then markets kind of bounce after that. So we had a good kind of flush come out of the market, so to speak, and got a lot of kind of sellers offside a bit. So again, not surprising, right at that support level, we saw some buying coming in yesterday. We'll probably see a little bit of follow through today. Now, just to let you know, momentum is still very weak here. We're on a sell signal, which is going to cap any upside that you have here near term. So very likely we're going to just be kind of continue to just be stuck in this range for now until something happens. We just don't have any catalysts for the markets at the moment. We're kind of, again, just going through this kind of the grind of this rotation in the markets. Yesterday is a good example. Walmart had a very big sell-off yesterday, not for any reason. It's just had a huge run, very overbought. So you're going to see some selling coming in, taking profits there, and looking to buy some stuff that's gotten cheaper. And you kind of saw that in the technology stocks yesterday. So that's that. That's that risk that we get into. So be careful chasing things that have already moved a lot, because we're very late in a lot of these moves. And that was really the juxt of that article I posted on Monday on the sector analysis, because that sector by sector analysis really shows the bifurcation in the markets and kind of what's driving that current rotation. So just be careful with it. Just kind of understand where you are, and you'll be fine. Crude oil is up a little bit, but again, we've seen a little bit of weakness coming in crude oil. We're still trying to figure out what's going on with Iran, of course, and kind of that whole situation. But oil prices are back on a sell signal here at a pretty high level. So there's some pressure here on oil prices in particular to fall lower. Now that should also help feed into inflation prints a bit if that occurs. So again, just after we had a very nice run in oil prices, again, they got very overbought here, very extended, starting to work off on that. Again, it's holding support. Oil prices are holding support right now, so no big worry. But if we take out this $62 level, we're probably looking at the 60s and the high 50s on a pullback in oil prices. And so kind of keep a watch on that, because that'll feed through potentially to some of these other areas like energy, which is, and again, energy's been one of those areas that's just been on fire lately. And the underlying revenue driver, and this is in today's daily market commentary, the underlying revenue driver of energy stocks is oil prices. That's where the revenues come from. If oil prices are falling, you've got some risk here. But look at this massive move in this momentum indicator for energy stocks. It's extremely elevated here, and you're about to trigger a sell signal from a fairly high level. So if you haven't taken profits in energy stocks, you may want to consider just rebalancing your risk here a bit. You're very overbought on a relative strength basis. That's starting to roll over here a bit. So that's kind of just a really good indication to maybe take a little bit of money off the table and just rebalance your risk. That's what you need to know before the bell this morning. We'll come back, pick up with your live Q&A. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Say the word annuity and people cringe, but here's the truth. Annuities aren't the enemy of your retirement. Wall Street billionaires don't worry about running out of money. You do. What you're being told about annuities is wrong. Our next Candid Coffee will show you how the right annuities can reduce market risk, create lifetime income, and even replace bonds in today's volatile environment. Join Danny Ratliff and me for Candid Coffee, Saturday, February 21st. Before you dismiss annuities, get the facts and a plan built for your retirement reality. Candid Coffee, Saturday, February 21st. Register today at realinvestmentadvice.com. That's realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. Getting into some live Q&A. So again, if you're in our chat right now, just jump in there, ask any question that you've got. We're more than happy to try to get through and answer it all. Good morning, Danny. How are you?
Hey, good morning. Great.
Awesome. All right, so what we got?
Got a lot of good questions today. I think one is an age-old question, one that many, many people consistently have, but one that can be addressed, I think, relatively easy for the most part. How can you determine if you have enough money to retire? What's enough?
Well, I think that's two things.
Yeah.
I think there's two answers to that question. If you ask my wife, there's never enough.
Well, if you ask most people, there's never enough.
And if you ask Danny, I'll never have enough. He won't let me retire. So, but in seriousness, Danny and I have talked about this before. There's all these kind of analysis out there. It's like, oh, if you have 25 times your income, you can retire. That sounds fine, except reality can be very different. And another problem that I see in a lot of the financial media is like, if you can just get to $1 million, you can retire. Well, $1 million in 1980, you could retire on because the cost of living was only about $40,000 a year. Cost of living today is vastly different. So $1 million isn't $1 million because of inflation and things that have happened over time. So how much money do you need to retire? Danny will tell you it can be all over the board. For some people, it's $10 million and they've got $10 million and they can't retire. Other people with $500,000 can retire. It depends on your spend rate. And you have to be honest about that. I ran into a guy the other day and he's driving, like a $100,000 car. He lives in a really, really big house. And then he proceeds to tell me that, oh yeah, when he can retire, he's just going to need about $2,000 a month to live. And I'm like, how are you going to even make that possible?
Yeah.
Right. Just your house taxes alone are going to be more than that. So I think you just have to have to figure out how much you need to retire. Danny is just a function of really getting a really, really good handle on how much you're going to be spending every month, and then inflation adjusting that over time, because you're going to have some other creeps that come in. You have medical costs, you're going to go up, you're going to go see the doctor more as you get older, et cetera. But once you can get a really, really good handle on your spend rate, then you can kind of back into how much you need to retire. If it's, if you're spending $40,000 a year, $1 million at a 4% treasury gets you $40,000 a year. Now, the problem is that's not going to adjust for inflation, but you can back into the number you're going to need.
Yeah, I think this is a very easy question, but also a very difficult question because there's no one size fits all. And really what I mean by that is I've told people that have $500,000, yeah, retire. You're in great shape. Homes are paid for. There's no debt. They have good pension income, which we talk about, those are kind of going extinct. Not everybody has those anymore, but you start to factor that, Social Security, what they've saved, they're in great shape. Where I've told people with tens of millions of dollars, hey, probably not the best idea to retire because look at your spend rate. And, while Lance, I hear that too. I've seen that, seen plenty of people who are driving, fancy cars. In fact, about 15, 20 years ago, there's somebody driving a Ferrari. And if their accounts receivable from work did not come through, they were going to go broke.
Right.
And
they literally, I've run into so many people. They have, fabulous lifestyles.
Yeah.
Right. Fabulous lifestyles. And they are one paycheck from being bankrupt.
There's so many people like that. And it's funny because a lot of these other people think they hung the moon because like, oh my gosh, look at all the things they have. But then behind closed doors, they're sweating bullets because they don't have money saved. And so I think that, number one, live beneath your means. That's the easy part. Should be.
Should be. And Friday's article is, and we'll cover this on Monday next week, is the 10 Laws of Money.
Yeah.
And we're going to go over it on Tuesday with John Penn on 2 Dads on Money. But I've actually wrote an ebook. It's on the website now. So if you go to realinvestmentadvice.com, we have a new ebook called The Laws of Money and Wealth. And it goes through basically understanding how to get your financial situation in order so that you can actually build yourself into a retirement situation.
The basic concepts, kind of building the foundation of it. And I think that's important. But when you go through these numbers, we have to assume for what happens if markets decline, your portfolio goes down, and especially in early years, that's when it's really crucial for the longevity of your funds. But then we need to start thinking about what about the items that pop up? So, we're going to plan for specific things, but Lord knows that there's going to be a time where your car breaks down, the AC goes out. You're going to need additional capital for these types of things, or maybe a loved one needs some help, right? So you need to start factoring and baking those into your plan. And then what type of returns are you assuming for? There's so many times we see these lofty expectations, and unfortunately, they're not really realistic. And, I see plans a lot of times where they're 10, 11, 12% on a year-over-year basis. S&P long-term doesn't even do that. So we have to be very careful and also understand that these long-term returns that a lot of advisors tout or planners, when they look at this, that's great, but many times that's over a 50-year time period or a 100-year time period. You may only have 20 years. So what happens for you may be much different than what the market has done, looking back over this extended period of time. So we have to be very careful to make sure that we are playing devil's advocate. We are, number one, like Lance said, inflating those funds. We are assuming for lower market returns. Now, let's hope that they're much better, but I want to make sure that if we're running a financial plan for somebody, that what if the worst happens? What if you spend too much? What if the markets don't perform the way you expect? Can you withstand that in your portfolio and you still meet at the end of the day? Remember, these funds are for you to reach those specific goals. So whatever that may be, hey, I just need to keep a roof over my head. That should be goal number one. But then I want to travel. I want to give X amount to the kids. I want to give money to charity. Whatever that may be, write those down, assign a dollar amount to it, and back into all of this. And this should help that quite a bit. Question, though, to piggyback off of that was long-term care.
Yep.
Right. And long-term care is the elephant in the room. Many people are not prepared. It is a difficult scenario because, if you're married, you can maybe be able to count on a spouse, maybe not. Long-term care insurance is expensive. There are ways around it. We do like the hybrid policies. If you guys have listened for long enough, those are ways that we're going to lock in a rate. You know exactly what you're paying. You're going to pay that specific premium over a period of time, maybe a lump sum or over a specific number of years. And it's going to assume inflation with it typically. So you'll know. Now, the problem I see with those often is that many times they'll say, oh, it's going to cost you X amount for long-term care. And so somebody goes out and buys insurance for the full amount. Well, that's a problem. Mm-hmm. Instead of looking at, hey, I just need to subsidize this. So here's my Social Security. Here's the assets that I have. Here's what I need to kind of make up the rest of it, or to, just to soften the load of what my portfolio must handle. So keep that in mind. A thing that a lot of people don't consider is if you do own a home, you could typically do a reverse mortgage. You could sell the home, move into a long-term care facility. There's lots of different ways to go about that. But another thing to kind of think about when you're going into the plan. Next question. We're going to get some market stuff.
Real quick before we get to that. There's this everybody in the chat saying, good morning, and to chat. But they're also talking about they're excited about drinking coffee. Study out yesterday from MIT and another, I think it was Boston University. I was telling Brent about this yesterday morning. They just did a 4-decade study on 180,000 people and found out that if you drink 2 to 3 cups of caffeinated coffee, decaf doesn't count, has to be caffeinated coffee, 2 to 3 cups of caffeinated coffee a day lowers your dementia risk by 11%.
I'm going to be in good shape.
There you go. So drink that coffee, people. That way you'll remember your kids.
Yeah, a way to piggyback that on long-term care.
Exactly. Drink more coffee. My long-term care is a cliff. just my wife's already said she's going to wheel me over just whenever it comes that time.
And we're going to wheel you out of your desk, like you mentioned earlier. He's on the dad plan, diet desk.
Yeah.
So, well, these are all great questions. And, actually this weekend, this Saturday, we're doing a Candid Coffee, Richard and I, talking about annuities, the good, bad, and kind of look through how you could use something like this. That may be something to consider to supplement income. I think they get a really bad rap. Look at them as a tool in the toolbox. We'll kind of talk through that, answer questions, kind of like we're doing now, but more specifically on that topic, just how to bridge that gap of making sure you have the income that you need. Another question was, still working, turning 65 next year. How do I plan to look at work benefits selection versus Medicare? So work benefits historically, number one, you want to make sure you're on a creditable plan, 20 or more employees within the company. Call the HR benefits group to ensure that you are. Sometimes you do get some back and forth banter there or information that may not be correct. So make sure you're dotting your I's and crossing your T's on that, because if you're not on a creditable plan and you don't get on to Medicare, there is a problem. Number one, a 10% penalty for every 12-month period. Also, you could be denied coverage, or your premiums could be much higher on your Medigap. So things that you must consider. So don't take this, this type of decision lightly. Now, if you are on a creditable plan, I would highly recommend, or you want to compare apples to apples, but most people will stay on that plan because it is subsidized, and you're likely are going to be paying less over longer periods of time. So you may not also be employed, but your spouse may be, so you can still stay on that plan. You have a 7-month period of insurability, or an open enrollment, so to speak. And then when you turn 65, 3 months prior, the month of your birthday, and then 3 months after, if you continue to work, you'll have an 8-month period. Remember, COBRA does not count as a creditable plan. So if you know you're about to retire, you're over 65, go ahead and get the ball rolling. Visit with somebody. We do have consultants here who can help you with that as well. So keep that in mind. Lance, a couple questions on allocating capital in a market like this. Markets are floating around highs, seem to be teetering back and forth. Market breadth has improved. How do you step into this market? We've had 2 or 3 of these questions today.
You buy the stuff that's been sold off, and you sell the stuff that's overbought.
So kind of this factor rotation, more or less.
You just start buying the stuff that, look, you take a look at software stocks. They've been just incredibly beaten up. A lot of those stocks trade at very big discounts to their forward valuation. So there's an opportunity there. And it's always interesting. Nobody ever wants to buy the stuff that's beaten up, but that's where your opportunity is.
Yeah.
Right. So if you want to start allocating capital, again, I wouldn't, allocating capital is not hard. I mean, you can, if you're buying an S&P index fund, you just buy the S&P index fund because the rotation is going to take care of itself inside the S&P index. But again, start looking for opportunities and things that have been really beaten up, and look to scale back. Like I was talking about energy earlier this morning, it's extremely overbought, about to trigger a sell signal. Take some profits there, and then look to buy some stuff that's really, really oversold, where there's still where companies still have a lot of revenue growth. They still have a lot of kind of forward earnings growth power, and start looking to acquire some positions. Again, you don't have to go all in. You can just start nibbling, because things may, we're still in the middle of this rotation, so things still may get a little bit cheaper, but there's certainly some opportunities there.
Yeah, and I think the big thing is right now is that so if you were bringing assets in here, and we were going to help you manage them. Now, it's going to be contingent on a couple things. Number one, is it all cash and you're just now stepping into the market? Well, then that conversation is probably a little bit different, where we are stepping in slowly. We may allocate half of the equities, look at the ones that we may be about to sell and say, we'll probably hold off on these. But in general, we would be stepping into the market, then start to rebalance over time. And as we're adding positions, add positions. Now, PEs were, at 10. Or 15 or below, I think we'd have a different conversation. We'd say, hey, let's allocate everything all in. Now, if you are, let's say an IRA comes in, you're fully allocated, well, we'll just likely move that out for the positions that we would like, so we can be more efficient, manage the funds properly. Things look a little different depending on the type of account. If it's going to be a taxable account, we obviously have to be considering what are the tax consequences if we were to sell positions, move into others. We can get pretty deep in the weeds on this one. Kind of in a similar type of road here. What to do next year after earning 5% already year to date? Maybe go to money market to earn another 2 to 3, or do you stay allocated? This is one of those questions I think many people are struggling with. If you've done well, should you jump out, sit in cash, wait for next year? And I think that's always I
don't have any problem with that at all. If your goal is 6% a year and you've already made 6 and you go to cash for this year, it's fine. But here's the problem with it, though, is that the market's going to keep running, and then you're going to
go back to that other question. How do you get back into the market?
Well, that's going to be one. Or you're going to go, oh man, I'm missing. I got to get back in, and then you're going to buy the peak of the market and wind up losing everything you made. So, that's always the problem with trying to jump in and out of the markets. It sounds good in theory, but emotionally and psychologically, it tends not to work out well because of the behavioral biases that we do over time. You're better off just to stay allocated and manage your risk. Again, as I was talking about earlier, take a look at staples, energy, materials, industrials, transportation. Those sectors are extremely overbought. And you've probably, if you're up 5% for the year, you're probably allocated to those sectors because those are the sectors that are up the most this year. trim those back, take some profits out of those, reduce. That doesn't mean sell them all. It just means take some profits out of them. Just cut them back to your original target weights, or pick a level and just take that money off the table and put that in cash for right now, and then wait for your next opportunity to buy something cheaper. But definitely reduce that exposure to extremely overbought, deviated sectors. And then you can survive whatever volatility comes this year. And eventually you'll see an opportunity like, oh, there's something cheap that's starting to go up. Let me go buy that. And you've got some cash to do that with. So again, it's more of a process of management rather than being all in and all out.
All right. Thanks for that. So do you think the recent Bloom Energy fuel cell success powering AIDCs will spread to other competitors like FCell?
Nope. Bloom Energy is kind of in a league of its own right now. So, again, we own Bloom Energy in one of our thematic models. It's done fantastic. But that technology is a bit different than other companies that are out there. And, if fuel cell is a good example, if fuel cell's been around forever. Plug's been another one's been around forever. If those companies were, going to be the next kind of level, markets would have already sniffed that out, and those stocks would be up dramatically, and they're not. It's not. So I wouldn't. If you're worried that you missed out on Bloom Energy and you're looking for somebody else to go buy to try to play that catch up trade, you might get lucky. Maybe the market will. Maybe the market just momentum will try to pick that up a bit. But just on a fundamental basis, Bloom Energy is a much better position.
All right. Thank you for that. Now we have one kind of 3-in-1 here. How will a price floor on strategic minerals distort markets? Will it have a similar effect as a minimum wage in a labor market? Is there trading opportunity here?
Well, the trading opportunity is going to come with the supply-demand imbalances in the market. So that's going to be that. So the price floor. January 29th, this is what's going on with price floors. January 29th, Reuters, U.S. moves away from critical mineral price floors. February 5th, 6 days later, U.S. pushes price floors on critical minerals. So, I'm not even sure the government knows what they want to do, and this is back and forth. Price floors are fine in theory, right? In theory, I establish a price floor. So, let's say that critical minerals, we're going to put a price floor of $10 on it, so $10 an ounce or whatever. In theory, right, this works because now as a rare earth mineral producer or critical mineral producer, I go, well, I can always get $10 for it because that's the good floor and I can make money at $10. So I'm just going to go out and produce a bunch of stuff because I can always sell it at $10. Well, then you get a supply demand imbalance, right? You start getting a big influx of supply. The price floor is fine, but then the price just is stuck at the floor because you've got all this supply coming in. With commodities, it is always a function of supply and demand. And more importantly than anything else, so now this is rare earth metals, this is gold, this is silver, it's any type of mined oil, it's any type of mined or produced commodity, cotton, wheat, corn, soybeans, orange juice. It's always a function of supply and demand. Remember a couple of years ago, about 3-4 years ago, y'all were all whining in the chat about the cost of eggs. And it's like we're having all this inflation because, inflation's going through the roof. Have you seen the cost of a dozen eggs? And that was a function that you had an avian flu that had wiped out a bunch of chickens. So you had an imbalance of supply and demand. Then the future markets jump on that and they run the price of eggs up because there's this perceived imbalance of supply and demand because of the avian flu on eggs. Have you seen the price of eggs lately? Egg prices have collapsed because we now have an oversupply of egg production because we've solved the avian problem and now we're producing and we put on a whole bunch more chickens. So now we have an oversupply of eggs and now the price of eggs are falling. That's the way every commodity works. The prices are driven by supply and demand imbalances and the futures contracts on the NYMEX and the CME. And when those future contracts start trading in one direction or the other, you can get big distortions in price. Again, we saw this with silver. Everybody was wanting to buy silver, so everybody in the futures market was driving the prices of silver higher by leveraging their trades through the futures markets. Well, when that reverses, you get big reversals in price because then they start shorting it all in the other direction. So again, this is just how that cycle works. So back to your question, though, price floors are fine. but they don't really work long term because you're destroying the underpinning of capitalism, which is that at times when there's an oversupply, you need manufacturers to cut back on production so you can get that supply-demand balance back in line with each other, and price floors potentially distort that process. So, but we'll see what happens.
I'm excited to hear your take on this next one.
Sure.
So, rather than paying for an extended warranty for a car, how much do I need to self-insure? What do you think about?
I never pay for an extended warranty.
Yeah,
ever.
I don't either. Now, you need to consider.
I buy Toyotas pre-2020. They're bulletproof engines, and I don't have any maintenance issues, so I don't need an extended warranty. Buy the right car, you won't need an extended warranty.
Yeah, well, and you also need to consider, do you have funds set aside that if something were to happen, that you can take care of it? And I think that's why extended warranties are so popular. And they wouldn't be offering them if they're not making a ton of money on them.
Oh, they make a killing.
Yeah. And you see, how many of you guys right now, if you've bought a car in the last 5 years, are getting, I don't know, a couple mailers every week?
Yep.
I know I get them. It's crazy the amount. And so the amount of money they're spending on marketing, there's got to be something to it. So in general, I'm not a big fan. I think if you can self-insure on it, great. If you have a car that does have problems, maybe it's something you should consider, especially if you don't have the capital set aside or readily available to go and put funds to work there. But yeah, that's. But
that's why my next car is be a 1972 Bronco, something like that.
That so you can actually physically work on.
Exactly. I'm going to buy something, drop a 350 cubic engine in it that you can just crawl into the engine cab with, do your own maintenance. Yeah.
You can't even change the batteries on half these vehicles.
Exactly.
Now.
It's crazy.
They hide them. It is crazy. All right. How much trust can we place in forward guidance on earnings calls? Is forward guidance always unbiased?
No. Forward guidance, earnings guidance is very biased. It is done by the Wall Street analysts who are then paid by the underlying companies that they do business with, doing secondary offerings, et cetera. And if I, put a sell rate, this is why there's no sell ratings on companies in the markets. Because if I put a sell rating on a company, then why would that company allow me to do their secondary stock offering or do their, investment banking needs, et cetera? So there's no benefit for that. So the analysts are always overly optimistic about earnings because it keeps their relationship with the companies they're working for in a good position. So when you see the earnings estimates, discount them by 30%, and that's about what you're going to wind up with at the end of the day. Because normally, historically, going back through history, from the first estimate that comes out, by the time you get from the first earnings estimate to the actual earnings, there's a differential of about 25 to 30%. So if you just see, like we're about to start getting, we got earnings estimates in March of last year for 2026. So in another couple of weeks or so, we're going to start getting earnings estimates for 2027. Discount those by 30%, and you're going to have a good idea about where you'll wind up.
Yeah, no, I think that's a great question. All right. Full disclosure, we do own this within portfolios, not recommendation. Do you think Palantir is oversold?
Yes. Would you buy it here? Not yet. Give it a little bit more time to kind of work through. It's trying to base here a bit. Obviously, this is one of those. This isn't the AI. I'm so concerned about AI that blah blah blah, whatever the thesis is, but it's just starting to form a base here. It needs to form a base bit here, but it's on a monthly and weekly basis, it's very oversold. And you're about to, if you get a little bit of price move on Palantir, you're about to start triggering weekly buy signals, which has typically been a really good entry point. And we'll still need to but again, this could take a little bit more time to work itself out. So if you want to start building a position, nibble, very small, and expect to buy potentially at lower prices or potentially expect to buy at higher prices. But you can start nibbling, but I wouldn't make a big commitment right here expecting this to be the bottom. It's still too soon.
All right, here's a good one. Will data center CapEx end up looking like fiber optic rage 25 years ago? I don't know that fiber optic ever had this type of momentum behind it and the optimism in general.
Well, it did. I mean, we were building fiber optic out everywhere. And then the problem was we didn't have a use for the fiber optic. We built all this fiber optic and there was no use for it until Google came along and said, hey, you know what? We're going to take the idea from the porn industry and we're going to start streaming live video across fiber optics. And then that just took off. Of course, that was YouTube. And then now we're using plenty of that fiber optic bandwidth. But it took a couple of years to get there. The difference with data centers is that need for those data centers is right now. There is already the need for that data source and those data facilities starting to be there. So all this CapEx they're spending is not on potentially future, kind of betting on the future come. A lot of that demand is already here. So in other words, it just may happen. That process may happen faster.
All right. Do you predict that corporate stock buybacks will be canceled this year due to AI CapEx?
There's been I've seen a lot of those graphs come around. It's like, oh, they're spending all this money on CapEx. They can't afford to do buybacks. Look, buybacks are really important for these companies. That's how insiders, we've had these discussions before here on the show. Buybacks are not a return of capital to shareholders because when they do buybacks, you don't get a check in the mail. The vast majority of participants in stock buybacks are corporate insiders. That's how they cash out their stock. I doubt there may be some incremental slowdown of buybacks this year, but considering the facilities and how buybacks are actually used by companies, I suspect there won't be a huge impact. I may be wrong, but we'll see.
Yeah. All right. This is a really good question. Will be 56 in August, $209,000 in a C fund. That's a thrift savings plan. So typically government employee, handful of options there. It's a common stock, basically index. I'll have a pension projected to be just under $2,000 a month. Am I safe to stay invested the way I am? The house will be paid off before retirement. I think we need a tad bit more context around that, or quite a bit. What else do you have in cash? Do you have any other funds invested? C fund is going to be one of your more, probably aggressive options. Picture the S&P 500. If you're 56, when are you going to retire? Is that 57 or is it 65 or 67 or 70 for that matter? I think there's a lot of information that we still need to kind of give you a better answer on that. If you want to provide some more context or send a question in, happy to visit, kind of give you some direction. But great question all in all. I don't know. So should you wait until 70 for Social Security? And I think this is one that's always an interesting one as well, because for years, you go back 10, 15, 12, probably about 20 years ago, a lot of people were actually taking Social Security early and just investing the funds. Rich talked about 20, 30 years ago, he used to do this a lot with clients, but valuations were much, much cheaper. I think the difference now is there's a handful of things to consider. Number one, if you're before full retirement age and you are still working, you're going to get a discount in what you would actually receive from your primary insurance amount, which is the amount you receive at full retirement age, or you also have an earnings test. So if you're still working, if you make more than a specific amount, they're actually going to withhold dollars from you. So I think you need to consider that. And every year you delay, you're going to get an 8% bump. So if you're married, you are the breadwinner. You do need to consider that, because if you pass away, your spouse will actually step up and receive your benefit later. So remember, if you are married, it is a partnership decision. You need to consider that and make sure that you're not, don't make the emotional decision. I think everybody thinks that, I've got to take it now. I've got to get all I can out of it. Well, if you live a long life, you're likely going to be leaving a lot of money on the table. And if you are married or your spouse lives a long life, you're going to be leaving money on the table. Now, if you don't have longevity, you're not in great health, or you just flat out need the funds, absolutely take it. But if you can delay, I think there's a lot of benefit to it. Question is, where all of this planning would make it a heck of a lot easier if we knew, would be, when's our expiration date? If we all knew that, we could all plan much, much differently.
You could pick an expiration date.
Only you. Only you.
Out in the woods. Danny may have a built-in expiration date out in the woods. So one day a bear's going to get him. So
yeah, maybe.
Or Michelle. Yeah.
I'm more concerned about the latter. Oh, man. All right, so we're going to get to the last few questions here. Lance, do you think market rotations are happening faster and with higher volatility now than prior times in history?
Absolutely.
Yeah.
That used to be, back in the 90s, rotations would last 1 to 2 years, and now they're happening 3 to 6 months. I mean, it's just the rapidity of these rotations has been quite amazing over the last few years. And we just jump from one sector to the next. And in fact, we'll see sector rotation. I've seen sector rotations just recently happen where it's been over the course of just 2 or 3 weeks, and you just have these big jumps in rotations. But that's just it's just the way the markets move now. It's just something you've got to be aware of. And that's what I was saying earlier. If you take a look at the stocks that have been on fire lately this year. In fact, this was, if you read the article on Monday, I've got a whole chart on this. But, you take a look at energy, transportation, industrials, materials, staples. They are extremely overbought here, extremely bifurcated from the other sectors of the market, which are extremely oversold. So that rotational setup is getting more and more stretched, where you're going to get a snapback in the other direction. It's just a function of time. It's just you don't know when it's going to occur. Just be aware, and when it happens, it'll happen pretty quickly.
Yep. All right. Well, I think that's about it. Do us a favor, though. Go to realinvestmentadvice.com. Go sign up for our Can of Coffee on annuities. Richard Rosso and I will be there tomorrow. Saturday, not tomorrow. So a couple days from now. If you have any questions for that, we'll be answering those live as well. Lance, you got any parting words?
No. Last question was, is FOMC minutes, does anybody care? Nobody cares. Just nobody.
That one in on me.
Nobody really cares anyway. But no, this is great joining us today. Be sure and get by the website. Like I said, that article on Monday, I went through a sector by sector analysis. I left out energy on accident. That's in today's daily market commentary. So you'll have to pick up energy in the second piece. But that's on the website now, realinvestmentadvice.com. And also, be sure and follow me on Substack as well. That's an easy, great place. At Lance Roberts on Substack. Easy, great place just to get all of our articles, all of our newsletters, all delivered in one place. Our daily videos, everything goes out there as well. So it's just kind of a place just to grab everything all at once. It's at Substack, at Lance Roberts. All right, y'all have a great day. See y'all back here tomorrow with Michael Leibowitz. See you then.